Welcome everyone, my name is NEERAJ. You have come to Thrive to Invest, the right place if you want to know more about investing. The topic of today's video is very interesting. We'll talk about why people don't invest in stock market. And I'll give you some facts before we start talking about it. The population of India is around 130 crores. Guess the number of people who invest in stocks. Is just 3 crores. That's around 2.5% of our total population. That is too low. If I compare this number with United States of America, so 55% of American population invest in stocks. This number was even higher before the financial crisis that happened. So why is that Indians are too afraid of investing in stock market? Why don't we get that confidence and put our money in stocks and buy shares? It is also a fact that most of us want to save money to secure our future, but very few of us wants to systematically invest that money against an annual return of X percentage that you have as a target in mind. Not a lot of people even understand the difference between savings and investment. To know a little more about it, you can click the link above. Now let's quickly talk about the 5 reasons that stop people from investing in the Indian stock market. The first reason is when you don't make enough money. If your income is too low and you're finding it difficult to make both ends meet, then it's understandable that you will not be able to invest or save money. All your income goes into your daily expenditures or necessities, and at the end of the day, you don't have any money left that you can put away as your saving or investment. The second reason is you do not have enough knowledge or awareness about how the stock market works, how to invest in stock market, what is the procedure, what are the requirements. The third reason is you may have basic knowledge, but you don't have enough confidence or trust in the stock market to invest in it. The fourth reason is stock market is considered as gambling or speculation, and it is not considered as a good moral practice. Fifth and the last reason is stock markets do not guarantee fixed returns as you get in case of fixed deposits or your saving bank interest. So if you're also part of that 97.5% population of India that do not invest in stock markets, is highly likely that is because of these 5 reasons. It can be one of these 5 reasons or a combination of few reasons from this list. Now let me make a very quick attempt to address all these concerns. I'll not talk about the first point because that completely depends on your income level, and if that doesn't permit you, it's understandable and we respect that fact. For other reasons, let's first talk about importance of investment. Investments are very important. I will highly recommend that you get into the practice of investing. Do not live in the present but plan for your future by actively and systematically investing your money in various tools, including the share market. It is very important to invest on a regular basis to secure your future and to attain financial independence. Your money should continue to grow even when you stop working. Apart from the compensation that you receive as your salary, your invested money should continue to give you passive income in parallel. Make a rule to set aside an X percentage of money every month from your income. That percentage can be as low as 2 to 5%, and you should invest that in a good tool rather than just saving it in your bank account or FDs. One tip and a bigger rule to follow here is be very careful and realistic when you are figuring out what percentage of income you should invest. Second point is, let's talk about the history of stock markets in India. In the 90s, there were a lot of scams that came up, the most popular one being the Harshad Mehta scam. I'm sure everyone is aware of it. And then in April of 1992, SEBI was established. SEBI stands for the Securities and Exchange Board of India. So the history of Indian stock market can be divided into 2 eras, pre-SEBI and post-SEBI. So let's talk about the main changes that happened after the establishment of SEBI. The overall investing environment and the ecosystem of the stock market became more regulated. There were more checkpoints, there were more processes and systems in place. The interest of the investor and the safety of all transactions became the priority, and all the functions and systems that evolved were around this basic principle. The second biggest change that happened after SEBI was established and the technology advanced was that everything converted from being in the physical form to online or digital. All your physical shares were now converted into electronic shares and were now saved in Demat account, where they were a lot more safer than being in the physical form. In the physical form, they were prone to being damaged, stolen. It was a pain to encash your shares at that time if they were damaged or partially burnt. But now, Keeping your shares in your demat account is a completely safe method. Nobody can take it away from you, nobody can damage your shares, nobody can burn your shares, so they are completely safe, giving you 100% peace of mind. No more delay in carrying out your trades in the online world. Everything happens at a click of a button and it's very instant. SEBI is also actively working towards reducing the T+2 time frame that exists today. In the pre-digitalization era, this time was maybe few days or even a week. Another important change that happened was around the brokerages that were being charged by stockbrokers. There was a time when they used to charge a very high brokerage amount, which has now come down to very negligible percentages, which are in decimals. Few brokerage houses even don't charge you anything. They give you certain plans wherein you are free to trade as much as you want. So certainly carrying out trades in the stock market have become more profitable, with your profit margin increasing and your cost coming down. So what I'm trying to tell you with all these points is, if you notice the changes that have happened after SEBI was established, you will understand that why people in the 90s were scared of the stock market, why they considered it as gambling. As there were a lot of scams, there was no regulator, everything was in physical form, there was hardly any transparency. These were enough reasons to scare people away from investing in the stock market. So if our parents or anyone from that generation have discouraged us from investing money in the stock market, now you know and understand why they did so. I think it's very reasonable for them to discourage us, and I think we should respect their opinion because of all the things that were happening at that time. What I'm also trying to tell you is that the current generation and the coming generation should be very actively investing in the stock market to reap its complete benefits and multiply your money. Also elaborating on the fifth point, which is about getting fixed returns in the stock market. It is true that nobody can guarantee you returns in the stock market. If somebody is doing that, they are cheating you. The world of stock market is full of volatility. I completely agree that. A lot depends on your entry or exit point. Still, volatility doesn't necessarily equal to risk. So you shouldn't stop yourself from investing in the stock market. If you invest intelligently, you're sure to get good returns, at least better than the FD and the savings account interest or even mutual fund at times. And you will definitely be able to beat inflation once you actively start investing and get more experience. The past 10 to 20 year data of annualized returns from the stock market is a testimony and a proof that it always beats inflation and gives you good returns. So as a follow-up discussion, in case you want to know why you should invest in stock market and for more tips around investing, please continue to follow this channel. Please subscribe the channel if you have not done it yet. If you're able to relate to any of the points that I just shared, please comment below and let me know your thoughts around it. I'll be back with the next video very soon. Thank you.